Understanding Murabaha, Cost Plus Financing. This module covers Murabaha sales and provides a practical explanation of their Sharia-compliant execution. A Murabaha is a sale transaction in which the cost of acquiring the asset and the profit earned from it are disclosed to the buying client. What a Murabaha does is combine an ordinary sale with a credit component to create a straightforward asset financing instrument. Is it permissible to buy an asset for $10 million and sell it for $10.5 million? Yes, it is. And can that $10.5 million be repaid over time? Absolutely. Can a Murabaha be used to simply lend cash? No. Islamic banks use Murabahas in order to fulfill asset purchase requirements, but not as a means for providing a liquidity finance facility. Typically, the bank purchases an asset, for instance a car, and sells it to the customer at a profit. As a necessary condition of the Murabaha sale, the bank must specify to the customer the exact cost incurred to purchase the car and the profit charged while selling it to him. Today, Murabahas are among the most widely used products in Islamic banking because they entail less risk and because the financial institution is aware of the profit that it will earn beforehand. Let's take a look at our learning objectives for this topic. By the end of the Murabaha modules, you will be able to define a Murabaha and identify its integrals, understand the 7 steps involved in the implementation of a valid Murabaha transaction, including client's purchase requisition, master Murabaha facility agreement, client's unilateral promise, agency agreement, possession of Murabaha goods by the agent on the bank's behalf, the exchange of the offer and acceptance between the bank and the client, and the transfer of possession of the Murabaha goods from the bank to the client. Each of these are discussed in sequence and in detail. Understand important concepts such as gharar or contractual uncertainty, hamish jiddiya or earnest money, khiyar al-aib or the purchaser's option to return a defective asset, and bay al-ina or buyback. Identify the most common mistakes that affect the correct execution and validity of the Murabaha transaction. Specify the restrictions necessary to ensure a Sharia-compliant Murabaha sale. Identify risk mitigation techniques to ensure adherence to the sequence of steps. Understand the treatment of default. Explain the prohibition of a rollover. Propose the method of managing an early repayment by the client, and calculate the profit in a Murabaha. What is a Murabaha? A Murabaha is a sale in which the cost of acquiring an asset, in addition to the profit earned from it, are disclosed to the buying client. The execution of a Murabaha must be Sharia compliant by ensuring strict adherence to a certain sequence of procedures. This sequence will be carefully explained in due course. Before we list and discuss the key elements that constitute the steps for the execution of a Murabaha, let's first establish their prerequisites in relation to the subject matter and price. First, the subject matter, namely the Murabaha asset, must exist at the time of the contract's execution. For example, a Murabaha can be executed for a car that exists, but not for one that has yet to be manufactured. Second, the bank must own the asset and hold either physical or constructive possession of it. Now let's build on our knowledge of the prerequisites of a Murabaha transaction by identifying the various steps involved in its execution. Murabahas are sensitive to missteps, and it is absolutely necessary to ensure that all the steps involved in the execution of a Murabaha are adhered to in the correct order. Each of these are discussed individually and at length, and should be a frequent point of referral for you as you perfect your understanding of Murabahas. First, the client's submission of a purchase requisition for Murabaha goods. Second, the Master Murabaha Facility Agreement between the financial institution and the client. Third, the client's unilateral promise to purchase the Murabaha goods and the financial institution's acceptance of collateral. Fourth, the agency agreement between the financial institution and the client or a third party. Fifth, the possession of the Murabaha goods by the agent on behalf of the financial institution. Sixth, the exchange of an offer and acceptance between the client and the financial institution to implement the Murabaha sale. And seventh, the transfer of possession of Murabaha goods from the financial institution to the client. Now let's look at these steps. First, the client makes a request to the bank for the purchase of a particular asset. Based on the purchase requisition, the bank approves the credit facility for the Murabaha before entering into an actual agreement. Next, the financial institution and the client sign the Master Murabaha Facility Agreement.